really hasn't been a shock in interest rates. So the question again becomes, how long does oil prices remain higher? And the bond market's kind of pricing in that we aren't going to see a dramatic inflationary pressure, but we'll see, because that information can change. Yeah, so again, this goes back to a little bit to what I was talking about before, is this wealth separation. So, everyone always talks about the 60-40 portfolio, which has 60% in stocks and 40% in bonds. And most financial advisors out there and anyone off the street you talk to would say, well, that's a good diversified portfolio and that's how it should be. Well, when you're going through these wealth separations, when it comes to the wealth divides, the government bailing things out, printing money, and then the Federal Reserve that controls demand in the economy. I mean, that's why, before 1913, when the Federal Reserve was created, the markets priced in the demand and priced in interest rates. Now you have an actual entity controlling rates. So my point is, with all of this, I think that bond allocation has gone down and that stock allocation has gone up, because again, when you have inflationary pressure, if you study, global history, what happens with the British Empire, Dutch Empire, Roman Empire throughout time, what tends to happen is your currency gets devalued because of the printing of money. Then you have to print more money essentially to make the people happy, and all that does is make inflationary pressure true, and the rich and wealthy get richer. And then you also have these geopolitical events of other nations not wanting to own the U.S. debt because of these things on the horizon, because of tensions with the Middle East, because of tensions maybe with Russia and China. You're already hearing countries not wanting to own U.S. government debt. So the pathway, even though the Federal Reserve might try to lower interest rates, and they have, the interest rate market really hasn't adjusted. So my point is with that is I think this is a good time to own stocks for the next 10, 20 years because, again, we're going through this wealth separation. Well, look, I mean, just 4 or 5 years ago, we learned real quick that the retail traders and retail investors have a lot more power, I think, than what many institutions realize with these meme stocks coming about like the GameStops and AMCs. So now what GameStop did is they raised a ton of cash. I think they did some offerings out there, and now they're sitting on $9 billion of cash. And if we talk a macro aspect of this, I mean, there's so many companies out there like the Apples and Microsoft, softs of the world that are sitting on hundreds of billions of dollars of cash. So if interest rates are potentially going low over the next few years, you're going to see a lot more mergers and acquisitions with some of this cash getting deployed, and even companies borrowing money if interest rates go lower. So, but this deal right here doesn't make much sense. I mean, GameStop's has $9 billion of cash, $11 billion market cap. That puts it at $20 billion potentially out there. eBay's a $56 billion company. So they did secure $20 billion of financing elsewhere, but still not enough to cover it. So I think it maybe was more of an attention thing going on here. It's like kind of like, the gym I used to work out in growing up, that, the clingy metal gyms trying to acquire, Planet Fitness down the road. It doesn't really make too much sense there, but this trend is going to continue to happen with M&A picking up, which is why I think investment banks remain a good spot to invest.